Good afternoon. Thank you all for joining us today for the latest edition of our Fort Pitt Capital Group webinar series. My name is Chuck Matusi, financial advisor with Fort Pitt Capital Group. I'll be hosting the webinar today along with my colleague, Paul Brahan, also financial advisor with Fort Pitt Capital Group. And we have a guest presenter from one of our partner firms here with us today, Amish Dalal. Amish is a portfolio manager and head of option strategies with North Coast Asset Management. We're really excited to have Amish join us today, and he'll be presenting here in just a bit. So moving on to a little bit of background information on our firm, Fort Pitt Capital Group is a investment management and financial advisory firm. One of, I think, actually two of the kind of most important things to us here at Fort Pitt Capital Group are really maintaining a boutique type feel. We have all of the resources of a much bigger firm, but we always want to keep that culture of a smaller independent firm that really customizes portfolios for our clients and focuses on achieving client goals and really just maintaining that local independent type of feel. One of the other things that's extremely important to us here at Fort Pitt Capital Group is continually providing exceptional client service. That's always been important to us. Our clients are our highest priority, and we always strive to deliver the highest level of client service for all of our clients. So a little bit about myself. My focus as an advisor here at Fort Pitt has always been to help clients kind of navigate through making and determining a plan to ensure that we're always meeting your overall financial goals. I'm very passionate about what I do and love the work that I do in helping clients put that plan together and reach their goals, intermediate and long term. Outside of work, what keeps me busy, I have 3 young daughters, so that kind of takes up most of my time. When I do have free time, I love to be outside and play golf and just staying active.
Good afternoon, everyone. Paul Brahan, also a financial advisor at Fort Pitt. I am a certified financial planner, chartered retirement planning counselor, and a certified exit planning advisor to help small businesses transition, exit to the next stage in their life. And we do have a webinar in November that I'll be talking on that topic. Similar to Chuck, I'm very goals focused. People ask what I do, and I say I help solve mysteries. And they say, mysteries? What do you mean by that? But it's true. We help people solve mysteries, and those mysteries might be, how much do I need to retire? When can I retire? If I can't, how much money do I need to be putting away, or can I delay to a different point? Can I afford to buy an investment property or a beach house? Just a few of the mysteries that we help solve here. In my free time, I'm a big foodie. I love to cook, love to try new restaurants, spend some time hiking with my wife and my dog. I have an English Bulldog, Murphy, and I like golfing as well. So like Chuck mentioned, we have Amish Dalal on the line, and I'll turn it over to him for his introduction.
All right, thank you very much, Paul and Chuck. Good morning and good afternoon, everyone. My name is Amish Dalal, Senior VP and Portfolio Manager over at North Coast Asset Management. I have about 19 years of industry experience. I graduated with a bachelor's in economics from UCLA, a minor in political science as well. Shortly thereafter, I moved to New York and I started my career at a fixed income asset management company in, in New York City. Also a CFA charter holder, graduate of the Global Executive MBA program at Columbia Business School in New York and London Business School in the UK. I've been with North Coast Asset Management for over 4 years, helping to run the almost $1.6 billion that we have in our concentrated stock strategies and in our option overlay portfolio. So we're really excited about this new partnership between North Coast Asset Management and Fort Pitt. I think we're going to have a really productive conversation as it relates to concentrated stock and options portfolios. And we want to express our thanks to both Paul, Chuck, and the rest of the Fort Pitt team for inviting us to join on this webinar today. So thank you very much. And Chuck and Paul, we'll hand it back over to you guys.
Perfect. Thanks, Amish. So one housekeeping item before we get started here, how to interact. So we welcome questions. Please don't be shy. If you're on a mobile device, that second icon on the left-hand side where it says Q&A down at the bottom, click right here, and you should be able to input a question right through that chat box. On a computer, it should be smack dab in the middle of your screen, right at the bottom, same icon as the mobile device. So, ask away. That's what we're here for. So we wanted to start by talking about what is a concentrated stock position. So a concentrated stock position refers to holding a large portion of an individual's or an entity's wealth in a single stock. A general rule there is 10% or more. And it could be, accumulated a number of different ways, but it's common among company executives or employees receiving stock options, stock compensation, people that inherit stock from family members, also long-term investors in high-performing stock. We've seen that recently with a lot of, high-performing growth stocks.
Thanks, Paul. So just take a second and talk a little bit about the pros of concentrated stock positions. And those include high growth potential, tax efficiency, emotional or strategic reasons, and also dividend income. So high growth potential, obviously, if you have a concentrated stock position in a stock that's performing, extremely well, a growth stock that's done well, then that's obviously a pro. Tax efficiency, this really specifically kind of talks to more of the long-term capital gain as opposed to short-term. So if you're holding a stock longer term, as opposed to holding it over a short term and selling it within less than 12 months. As far as the emotional or strategic reasons, some folks may have inherited a stock from a family member and they have an emotional attachment to it. Some folks may have worked for an organization and received stock options over many years, and now they have a built-up concentrated stock position, and they may have some knowledge about the particular company because they work for them or used to work for them. And last but not least is dividend income. If you have a concentrated position in a dividend-paying stock, that can create a substantial cash flow for that particular position. So let's talk a little bit about the cons of concentrated stock positions. And a couple of these in particular I want to focus on. And one would be the high risk. So what we mean by this is if a client has a significant portion of their net worth concentrated in one position, they are kind of at the mercy of how that particular business does. Their financial future can be kind of based off of that. To give you an example, if a client has 30% of their net worth in one stock and that stock is down 50%, you can see how that can have a huge impact on their overall financial situation. So that is risky, and that's where we want to recommend diversifying out of a position like that if possible. And some of the strategies that we're going to talk about here later allow us to do that. Limited liquidity. So this would relate to if, again, a situation where a majority of somebody's net worth is tied up in one particular position and they need some liquid cash to make a purchase or fund something, and it's all tied up in this one position, that holds them a little bit captive. And then also, tax implications. So if what we see a lot of times with concentrated stock positions is, these are positions that have been held for a long time, which usually translates to a very low basis. So if you have a low basis stock that you've had a big gain on, it makes up a large part of your portfolio. If you go to kind of try to move out of that position, there's a lot of tax embedded in that, and it can create a bit of a challenge. So that's definitely something that, you know, that can be a negative when looking at that. So we've talked about the pros and cons. Now let's talk about how we can use some different strategies to deal with concentrated stock positions. And these are some of the strategies that Amish is going to talk about here in a few minutes. So one of the strategies would be strategic liquidation, or spreading out the reduction of a position over multiple tax years. So kind of going back to the example that I used a second ago, where you have a concentrated stock position with a very large capital gain, we want to diversify out of that position. You don't want to take a large capital gain maybe in one tax year. So we can use a strategic liquidation strategy to spread that capital gain over multiple tax years. Another option would be using options to protect or hedge a position. Maybe a client loves this particular concentrated stock position, wants to hold on to it, but wants to protect their downside in the event that this stock falls on hard times. We can use some of these option strategies to protect that downside. And last but not least, using options to generate income. So looking back to one of the previous examples of, you know, the limited liquidity with a concentrated stock position, we can actually use options to generate income from that position, which creates some liquidity that clients can use for, you know, whatever it may be, for a purchase or for, you know, funding a vacation, or a vacation home, or something along those lines. So now we're going to transition to talking a little bit about North Coast. I'm going to just spend a minute talking about North Coast background, and then I'm going to hand it over to Amish to elaborate a little bit more on that, and then jump into what he is going to cover for us today. So North Coast Asset Management has 10 offices throughout the country. They also have over 40 highly educated and experienced investment management professionals. Most of, if not all of those folks, have particular designations such as Chartered Financial Analyst. Also, our combined organization under the COVID's umbrella is now managing just over $38 billion in assets. And with that, I'm going to pass it over to Amish to elaborate on that a little bit.
Great. Thank you very much, Chuck. And just to add on to that, we currently manage, as I said, about $1.6 billion of assets. And what that also represents is about 1,800 individual client relationships. So as a client, we don't put you in a black box with hundreds of other clients. We manage your own specific circumstances, your own specific position in your portfolios, and we take into account your own customized goals as it relates to the concentrated stock position and the options portfolio management. I also want to add that we have over 10 years of experience in running just the options portfolios, and that's in addition to North Coast's very long track record of over 30 years of experience within the asset management space, managing portfolios consistent with our investment models and taking very much a quantitative and fundamental approach to asset management. Now, Chuck and Paul did a really great job in talking about three things. Number one, what is a concentrated stock position? Now, I know that Paul mentioned 10%, but it doesn't have to be 10%. It's a very subjective interpretation. For some clients, it means having $1 million in a single name security. For another client, it could mean having that stock represent a sizable percent of their overall portfolio. But for some clients, it represents almost their entire net worth, because these clients may have been working at the company and received either stock options or stock grants, which have vested over the years and have grown over time to a sizable position of their entire net worth. So that is what is concentrated stock. The other things that Paul and Chuck did is they talked about what are the risks of a concentrated position: volatility, downside risk, and lastly, what are the opportunities? What can we do through an options portfolio management strategy That's why we're here, and that's what we're going to talk about. Let's go back to the risks of a concentrated stock portfolio. Okay, some of the risks are the capital gains taxes that a client is required to pay, oftentimes because they have a very low cost basis for their shares. And also clients who have a sizable portion of their portfolio in a single name security have an emotional attachment. Now, I mentioned circumstances such as that client working at the company for many years, and they have seen the company grow and it's served them well. So they might be hesitant to selling the stock, at least immediately, and certainly not at one time. And lastly, clients oftentimes have the long-term plan of passing on these shares to their kids so that the kids can get the benefit of the step up in cost basis. Okay, so that addresses some of the nuances, if you will, of a concentrated stock position. Now, of course, we have strategies to guide clients out of that single name security risk with the purpose of generating a more diversified portfolio, one that has exposure to a number of different sectors and industry and other names, right? How do you dampen that volatility? So reducing volatility and downside risk for the entire portfolio and partially hedging some of those risk factors so that your life savings aren't totally vulnerable to some of the idiosyncrasies of a single name stock position. Now, as I mentioned, Paul and Chuck really set the stage for the different strategies that we offer at North Coast. Let's go ahead and reiterate that, and then we'll talk about the approach that North Coast takes. So some of the goals that a client may have is that they want to hedge that downside risk. They don't want to see the value of their positions going down by 20, 30%, right? We've all seen periods of market stress. We saw what happened during COVID. We saw what happened in 2022 when risk assets fell 25, 30, even 35%. So hedging that downside risk, of course, is very important for clients with concentrated stock positions. Another goal that a client might have is to generate income. You might have a sizable position in a single name security, but chances are if you own some of the big mega cap tech names, you're not getting dividends or you're getting very low dividends. So you have no way to really monetize your position unless you sell. But then you have the capital gains taxes to be mindful of. And that's what leads me to point number 3, tax efficient liquidation. Everything that we do at North Coast, the approach that we take with concentrated stock and the strategy that we employ is to do a number of things. But one of the most important things that clients come to us regarding is how can we be tax efficient in our approach? How can we be strategic in terms of pairing gains with losses, or utilizing after-tax option premiums to help liquidate stock? These are some of the things that we do through one-on-one conversations between the firm and the client. And lastly, diversification. Now, it should come as no surprise that having your entire portfolio, or at least a sizable portion, in a single name security exposes you to a whole host of risks. And spreading those chips across the table can help minimize those risks. So ultimately, taking the path towards diversification is, I would say, one of the most important goals of a concentrated stock solution. So we obviously cannot do this in a vacuum. It is incumbent upon us as your fiduciaries to understand what are your objectives. Is it income? Is it downside protection? Is it to pass on these shares to your children so they can get the benefit of the step up in cost basis? Only until we understand what your objectives are can we then recommend a strategy that helps you achieve those goals. And that's where the active options management comes in. You see, with North Coast, we don't employ a set it and forget it strategy. We don't put on the options trade and then we forget about you for 6 months. We take an active and dynamic approach to making sure that we understand, have your risks changed? Have your goals changed either in the short term or in the long term? And also, macro conditions can change. The market is going to change. The economics that belie how the market is performing, that is going to change. The risks of your options positions are going to change. So what we do is we take very much an active and dynamic approach. If that means that we roll an option that now poses too great of a risk for your portfolio, we might decide to go ahead and pull the ripcord, close out of the options, de-risk your portfolio to allow for continued growth while mitigating that risk. And on the other hand, we might see opportunities over time to generate additional income. So that is all part and parcel of active options management. And that all ties in nicely to the solution that we're offering for concentrated stock. Let's look at an example. So we're going to use Apple as an example because it's a benchmark name. It's widely known as a multi-trillion-dollar organization with a really long track record. A covered call is simply this: selling part of your upside in order to generate income today. So let's use Apple as an example. Now, this one shows a strike price of $235, but just want to clarify that these numbers are when Apple was trading at around $203. What we're doing is we're setting a strike price that is, let's just say, about 15–20% higher from where the stock is trading. It's very much specific on the stock that we're talking about, but bottom line is this: we want to allow for growth in the value of your shares. Anything above that point is what we are foregoing. So we're generating option premiums, and in this example, using a $1 million position, that would impute generating about $27,000 in option premiums, which in percentage terms is about 2.8%. And if you were to annualize that, we're talking about generating cash flow of about 5.6%, which means a total return to you of 18.2%. That's when you factor in the upside on the stock that you're still allowed to participate in, as well as the income that's generated from the option premiums. So what role does North Coast play in this process? Do we simply sell the options and then leave the position in there? Of course not. North Coast's concentrated stock strategy is called a triple play strategy for a reason. What we do is we incorporate our macro model. So where do we see the economy, and where do we see risk assets when you evaluate current market conditions from the top down? And I'm talking about everything from inflation to interest rates to GDP growth, the impact of tariffs, the fact that we have a new administration as of January of this year that has a domestic and foreign policy that's very different from the prior administration. You see, these are some of the things that are going to influence our macro outlook. Do we believe that we are on solid footing? Do we believe that the market is positioned for continued growth? Or do we believe, based on our investment models, that quantitative approach that I mentioned earlier, that the market is now positioned for a pullback? That is how we take a top-down view of markets. Now we add to that our score on Apple. So what is it about Apple's earnings that either look really, really good or really not so good? Well, I can tell you this: top line revenue growth for Apple has continued to grow strong, particularly in the services sector, but also not excluding iPhone sales, which came in better than expected during fiscal quarter 2025, the third quarter of 25. Revenues came in better than expected. Margins widened by a greater percentage, and bottom line profitability continues to impress. So when you take that macro view and that opinion on Apple, it's incumbent upon us to structure a covered call strategy that allows for the growth that we're projecting while benefiting from the income from selling covered calls. That is how we employ an active and dynamic approach to options portfolio management. Now, what you just saw on your screen was what we call a standard covered call strategy. On this slide, what we see is more of an upside covered call strategy, one that allows for greater growth in the value of shares. And how we do that? Well, we employ the same active and dynamic approach that we talked about. We employ the same investment models and outlook that I talked about. The difference over here is that we take a more conservative approach. We utilize a higher strike price, not only to allow for greater growth in the value of the shares, but to better dampen volatility, right? So volatility, of course, is a risk factor in any portfolio. And the risk that you have pricing pressures over time can lead to unpleasant outcomes. So as your portfolio managers, what we do is we utilize a higher strike price, but we forego some of that income. So in this case, we're talking about $17,000 in option premiums for a $1 million position, which imputes about 1.8% or 3.8% in annualized premium. Your total return, when you factor in the maximum upside, in addition to the option premiums, is 22.1%. So slightly greater than the 19% that you saw on the previous page. So once again, this is a summary of our covered call strategies, which is a strategy to generate income against your concentrated stock position. Now, I know a question has come in regarding helping to understand options for clients who may not be familiar. The exact purpose of this webinar is to provide an introductory conversation about options, what they are and how do we utilize them. And of course, there are going to be opportunities at the end of this call to have a Q&A. We can talk in a little bit more detail about the strategy and the active portfolio management. And if there are any further questions, you can reach out to your financial advisor. We'd be more than happy to walk you through the nuances of an option strategy. But let's quickly transition to the caller strategy. So this is slightly different from the covered call strategy that you saw on the previous two slides. In this case, yes, we are selling call options, but the difference is instead of banking that cash as option premiums, what we're doing is we're utilizing that cash in order to provide downside protection for clients. So for clients who are concerned about short to intermediate prospects, we're concerned about a scenario playing out similar to what we saw in 2022 when risk assets declined by double-digit percentages. A caller narrows the range of outcomes. It allows clients to protect the value of your portfolios from an adverse move in the value of their shares. So let's look at an example. In this case, we may utilize a 170 put strike price, which protects the value of the shares from going beyond $170. So if there is a price decline in Apple that's greater than $170, the client has the comfort in knowing that at least the value of their portfolio is protected at $170. So what that means is you're exposed to that initial downside risk of about, let's just say 12 to 15%. Anything beyond that, you have the benefit of that protection. Now, the second benefit is that you don't pay out of pocket for this protection. That put option that protects you at $170 is financed by selling a call option at $250. So effectively, we're taking cash flows from selling part of that upside, anything greater than, I would say, about 15%, and we're utilizing that to buy protection. Think of it as taking out insurance for your portfolio to protect you, again, from severe downside risk. Now, this illustration shows utilizing options going out 1 year. And the reason we do that is because clients want to have the comfort in knowing that the terms of the trade are not going to change week over week or month over month. We're locking in those terms for at least 1 year. And there are tax advantages as well that we can talk about offline. But this is quite simply what a caller trade is: protecting the value of your shares, and then coming up with a plan that, are you comfortable selling your shares at $170? Do you want to sell a portion of your shares at $170 and continue the strategy with your remaining shares? So all options are still available to you as clients: keeping your shares, selling your shares, or generating incremental cash flows against the value of your shares. Now, I'm sure there are going to be a lot of questions. And so I want to make sure that we're allocating some time to Q&A. So as Chuck and Paul mentioned, you have the chat box that's available to you. Please don't hesitate to go ahead and send us a question, and we'll go ahead and answer them live. Thank you very much.
Thanks, Amish. We do have a few questions that came in. So I'll start with kind of paraphrasing and knowing what, in working with you and your team, what I know about your team. I just wanted to see if you could elaborate a little bit on the management of the different strategies. So I know you had mentioned to me before, every morning, I think, around 8 o'clock or so, you and your team gather and review the different options that you have open and kind of game plan on, is one of these strategies getting close to the strike price, and is there something that we need to do? I think the overall theme there is this is a managed option strategy. Like you had mentioned, it's not a set it and forget it type of thing. So just wanted to see if maybe you could elaborate on that a little bit.
Yeah, absolutely. And you're absolutely right that my team and I meet in the morning before the market opens in order to discuss a number of things. Number one, do we have a specific client instruction? For example, a client might say, hey, North Coast, I need to liquidate $100,000 of stock and I need it by the end of the week. It's incumbent upon us to determine what's the most effective way of going about that. So we want to make sure that we're executing the client's instructions as closely as possible. There might be other times in which we decide to make a wholesale trade. So let me give you an example. And I'm going to use the Apple covered call to illustrate this point, that when we're entering a sensitive time, either there is some economic report that's due to be released, whether it's a jobs report or an inflation report, the two of which came out recently, or it could be the Fed is about to make an announcement, right, with respect to what it's seeing in terms of data on an inflation front and provide indications as to what interest rate policy is going to be. We may opt to de-risk all of our clients that hold a specific name. So take Apple as an example. We were concerned about upside risk, right? Now, we had already seen the stock starting to trend up based on expectations that revenues would come in better than expected, and services revenue specifically surprising on the upside, right? We had already seen the technicals of the stock remaining strong as well as solid fundamentals. So what we would do in that case is, even if we may have an option that expires in February 2026, we want to make sure that our clients aren't exposed to the risk that we breach that strike price. So to your point, Chuck, what we may do is preemptively close options that are within spitting distance of that strike price and roll into higher strike prices. Because if you wait until after the earnings surprise, number one, the cost to close the old options may be prohibitively expensive. And number two, we not be able to engage in the same type of attractive trade that we could have the day before. So the most important thing is, how do we protect the value of our clients' shares? How do we allow for continued growth opportunities? And how can we be tax efficient in our approach? So these are some of the things that we'll map out before the market opens. And if it's in our investment determination to protect, to de-risk clients' positions and roll into higher strike prices, we may preemptively do so. Okay, that is how we engage in a wholesale trade rebalance. But again, if a client has specific instructions as it pertains to downside risk or as it pertains to generating income, we may just hand trade that individual account that allows for that continued growth and better downside protection. And on that note, Chuck, I want to make sure that clients understand what the risks of the strategy are. Take a look at the graph on the right-hand side. What the dotted line shows is the payoff of just owning the shares. So if the stock goes up by 5%, the value of your portfolio goes up by 5%. What the solid blue line shows is the payoff of a covered call strategy. So if you have downside on the stock, then you have a downside on your portfolio and you keep the full option premium. So let's say that the stock never reaches the strike price. Those options will effectively expire out of the money, and the client keeps the full option premiums and is retained as income. And what we do is then we'll go ahead and close the options, we'll book those gains, but then we'll sell new covered calls and keep that cycle going to continue to generate income for the portfolio. But what if the opposite happens? What if we set a strike price and it looks like the stock is about to approach that strike price or potentially even breach that strike price? Well, this is where the active risk management comes into play. What we will opt to do oftentimes is we'll close those options, like I described before, pre-Apple earnings, and we'll roll into a higher strike price in order to mitigate the risk that we've blown through the strike price, and clients are now at risk of those options being in the money and their shares being called away. That is the dynamic approach to covered calls.
Thanks, Amish. So in a scenario like you had mentioned, where, say we have a contract that expires in 6 months, the stock never reaches the stock or the strike price, so it's out of the money. The client pockets that premium, and then essentially start another contract. And realistically, in a particular situation, a client could continue to just collect premium on this position, every 6 months or so. Obviously depending on where the stock price moves.
Yeah, yeah, and I think you did a great job in summarizing the benefits of a covered call strategy. Okay, now we've been spoiled, right? We've seen the spectacular performance that stock markets have had since 2023. 23 was a strong year, 24 was a strong year. Year to date, 25 has been a strong year. Even though we had that pullback in the March-April timeframe, net stocks are up, right? So we've talked about a situation in which the value of risk assets and therefore client portfolios have grown in lockstep. But what if you have a situation where the market comes under pressure? Now, I know I mentioned COVID, right? But these things are cyclical, right? There are a number of times when you have stress in the market. It could be because the administration is talking about tariffs and markets are concerned about the dampening effect that could have on the US economy vis-a-vis the global economy. It could be concerns about how leveraged the average consumer is. There could be concerns about a spike in unemployment, right? Or the fact that interest rates might remain elevated for a longer period of time. So the point is that having income from a covered call strategy could be a great way to add value to a concentrated stock position, because according to the situation you described, if the value of the stock remains flat, or if the value of the stock goes up marginally, or even if it goes down in value, the benefit is you're able to bank those option premiums as income. And it could be a good way to add incremental value to the value of the portfolio. Okay, so again, those are out of the money options. But does that mean that if the value of the stock goes up and the value of the market is expected to continue to go up, that there is no place for a covered call strategy? Absolutely not. Okay, the great thing about options is that they can continue to provide income generating opportunities even in an up market. And in cases where we've breached the strike price on the options, we can be smart from a tax perspective, because we can utilize tax losses when closing options and use those tax losses that were harvested to sell stock at a commensurate amount of gains. So at least the client is able to tax efficiently sell a portion of their shares while getting the benefit, excuse me, of diversification. And I can tell you that typically when we take that latter approach of utilizing tax losses to sell stock at capital gains and being net tax loss neutral, that we're able to chisel away about 5 to 10% of a client's position in any single tax year. So if you do some quick math, what that imputes is holding on to a client's concentrated stock position for anywhere from 10 to 20 years on average. And if a client wants to accelerate that liquidation, we can do that. If the client wants to extend that, we can accommodate that as well. That's just to give you an understanding that we're not looking to blow out of a client's position immediately or within 6 to 12 months. We're looking to take a very opportunistic and tactical approach as it comes to managing the risks, but also the opportunities of concentrated stock portfolios.
Great. Fantastic. Thanks. We had a question that just came in. The question is, do you set the call strike based on a fixed percentage above current underlying price, or by utilizing the strike's delta?
Yeah, that's an excellent question. The answer is it depends. Now, I would say that the delta of the option is a good guidepost in terms of the strike prices that we utilize. But remember, through this partnership with North Coast, you're getting an active portfolio manager that utilizes a number of investment models at the macro and stock level. So if, in our investment opinion, a stock is positioned for really strong growth, then what we'll do is we'll err on the side of conservative and utilize a higher strike price in order to allow for that growth. Okay, so on the other hand, if, in our investment opinion, a stock is positioned for a pullback, either because it appears to be overvalued, valuation multiples look too rich, fundamentals are turning negative, we may opt to be a little bit more aggressive and utilize a lower strike price, because therein you're able to get more income from selling a more aggressive covered call. So again, the strike prices that we utilize are based on a number of things. It could be based on the delta of the option, but it also could be based on what our macro models are indicating in terms of investment outlook, and also what our models are indicating for upside or downside risk for the individual stock.
Amish, I know we talked about this a little bit on the call already, but can you talk about the minimums to invest in this strategy?
Yeah, absolutely. So the minimum is $1 million for the portfolio and $500,000 per individual position. So a client has, let's just say, 500,000 in Apple and 500,000 in Tesla. That meets the minimums for the strategies.
Thank you.
Perfect. I'll handle another question that came through. So the question was, if a client has a concentrated stock position and they have some interest in what we presented today, what's the next step? How do we, where do they go from there? And the answer to that is essentially, if you're a current client, then reach out to your advisor. Your advisor will then reach out to one of our partners at North Coast with the information on your particular situation. And then we will get a proposal and potentially a call set up to discuss the proposal with you, and then kind of go from there based on what we decide is the best path forward. If you're not a current client, we do have contact information that we'll share with you at the end of the call. You can reach out to our firm and get in touch with one of our financial advisors, and then we can again gather your information and come up with a proposal and decide what's the best course of action. So essentially, the first thing to do is just reach out to us, and we'll kind of take it from there and drive the process for you. Amish, one other question that I wanted to throw out, this question came to us prior to the webinar today. And I know we didn't really cover it, so you don't really have a slide for this, but I thought maybe if you could talk about it a little bit, just briefly. There's still a lot of clients that we come across that are sitting on a lot of cash. Say a client has a really large cash position. Is there a strategy that you all utilize in that type of situation where they have a big cash position, but they don't want to put it all in the market right away, but they want some market exposure? Is that something, and any type of strategy that you have that would fit that scenario?
Yeah, the short answer is yes, we do. The options overlay portfolios that we have at North Coast aren't relegated solely to concentrated stock positions, right? We also have opportunities available for clients with cash. So whether a client is bullish on the market and they want to supercharge that growth, or if they're concerned about downside risk and they want to protect against a severe downside movement in the markets, we have a strategy for that. We understand that some clients have a desire for income. We can utilize an option strategy that allows clients to generate really attractive option yields using our strategy. So to answer your question, yeah, if a client has just cash and they're looking to utilize options in order to participate in continued growth or to protect against the possibility of a pullback in the markets, or if they're looking for income opportunities, we can do any one of those things. Because these are more customized in implementation, I would say reach out to your advisor, who can reach out to North Coast, and then we can have individualized conversations that talk about the best strategy for that particular client.
Great. One other thing I wanted to cover, somebody had asked about, well, what's the cost, for this strategy? So at a high level, what I can say is if you're a current client, there is no additional cost, if you will, to utilize this strategy. The management fee that we collect for managing your portfolio would be applied to this additional position. If you're not a current client, please reach out to us and we can, review our fee schedule and how that would work. But I will say at a high level, knowing what some of the our competitors in this industry charge for strategies like this, it's very competitive, if not better, than what we've seen out there. And not a lot of other firms are doing the active options management like we see with North Coast, which is a huge benefit.
Chuck, I wanted to quickly refer to the questions that have come in. So Mr. Woke had mentioned that there could be an additional 15% tax that inheritors could pay other than spouses when receiving inherited monies. Absolutely. We've seen every sort of tax situation. And while we're not tax experts, what we can say is that clients that have a very specific situation as it relates to taxes, as it relates to income, as it relates to being below a certain bogey, right? Or if there is a death in the family, right? All the things touch upon taxes that are owed on the concentrated stock position, step up in basis, or what the client's risk budget is, or I should say the gain loss budget is for that tax year. So we can help clients navigate through all those situations so that we are as tax efficient as possible. Somebody by the initials of MC saying, what's the typical days to expiration or duration for the short call? I would say a good rule of thumb is that we utilize option durations that are typically in the 5 to 7 month range. We may be tactical. We may utilize 3-month durations. We may utilize 8-month durations, but I would say that in probably 90% of cases that we're somewhere between, let's just say 4 and 7 months. Now, the option expirations that we utilize are very much tactical. So what we'll do is we'll look at current market conditions. If we're seeing a spike in volatility, if we're seeing above average or below average premiums, that absolutely is going to influence the type of durations that we utilize for our options contracts. Because we want to be sure that we're not locking in terms that do not look attractive, right? Yes, we want to provide income generating opportunities. Yes, we want to protect against downside risk. And of course, we want to allow for upside growth in the value of shares. And after we've created our investment opinion, then ultimately what we're doing is we're selecting the optimal options contract as it relates to the strike prices and the expiration date.
Great. Thanks, Amish. Let's see, do we have, okay, I think we answered the other the other questions that we had coming in. Let me just make sure we got through everything. It looks like we did. Okay, awesome. So in closing, just kind of wanted to reiterate, anybody out there who is interested in these strategies and something that may pertain to your particular situation, first and foremost, reach out to us, get in touch with us, and we'll take it from there. There is no commitment required if you're just inquiring and looking to see what we can offer for you. So please reach out to us. Either myself or Paul or one of our other advisors will be glad to work with you. My contact information is here on the screen now. Paul's contact information is here as well. And last but not least, I would just like to say thank you to Amish. Thank you, Paul, for joining me today to host this webinar. We hope it was beneficial and informative for everybody. Again, we really think that this can be a great strategy for a lot of different clients and prospective clients out there. And we would love an opportunity to talk with you about it if it's something that you're interested in. So please reach out to us. So we thank you all again, and hope everybody enjoys their rest of their lunchtime, and everybody has a great day. Thank you.
Thank you very much.